Joining the conversation right now is the Chief Investment Officer of Huntington Funds, Randy Bateman. Randy, good to see you.
Good morning.
Thanks so much for joining us.
Thank you.
How do you see markets today?
Today, it doesn't matter. You know, we've seen this market switch back and forth.
I don't mean this actual
day.
Every
day is something different. You know, nobody can really
I've got Advil in my bag in the green room if you need it.
Would you put money to work in stocks right now?
Oh, I think so. You know, there's no question that we're looking at a dollar bill that doesn't really give you much of anything, whether you go with interest rates or international. Right now, I think the stock market's the only place you can go, and there's certainly some places that you need to be that can weather this. And I think agriculture is one area that you probably want to diversify. You're seeing a lot of money flowing into the GLD, the gold ETFs. I think there's no question that there's opportunities out there. And then, as we've discussed, we've got robotics as an opportunity. The Davos discussions were all about that, I think. The fourth industrial revolution, I think it's been termed. That's going to be the thing that's going to be the next big thing. Now, how it's going to unfold, we don't really know. We don't know whether or not it's going to be some kid in his garage right now that's going to build the next Microsoft that's going to be the robotics revolution, or whether it's the giant corporations like Google that are developing the autonomously driven cars. We just don't know where that's going to be, but it's going to be a big play. I think it's going to be more exciting and more dynamic than what we saw with the social media issues.
I was at a conference yesterday where there was probably $1 trillion of hedge fund money represented, and the broad section of the consensus there is that the market is slightly overvalued given where the expectation of where rates will be at the beginning of 2017. What's your reaction to that? You know, meaning we're in a 16, 17 multiple, the market should probably be at a 15 multiple.
You know, multiples are going to swing back and forth. I don't think it really makes a whole lot of difference. It's where your time horizon is the most important thing. I take a longer-term perspective on this, and I think if you can be diversified in this market, you're going to come out okay. You're never going to be able to pick the bottom. There's no question about that. But you can do some things that will mitigate the swings. And certainly we use option strategies a great deal. If you see a stock that's out there that looks pretty good, that you want, but you don't like particularly the price, write a cash-covered put on it. And I think that's the best way to go.
But do you think the broader economy is weak? I mean, certainly 15 was a lot weaker than people thought, right? A lot of people missed the macro story. So what's the macro story in 16, and does it impact earnings?
I don't think there's any question it's going to impact earnings. We've seen profit margins that have been pretty fat. I think the level of productivity starting to have crested, and I think we're going to see that start to diminish this year. And so I think corporations are going to have a little bit more difficulty with regard to their ability to generate earnings. However, that having been said, if you look back in time, we've got a situation where there is fewer number of corporations out there in which to invest because of all the mergers and acquisition activity, and we've got fewer shares because of all the buybacks that have taken place. Thomas Paine once said that what we obtain too easily, we esteem too lightly. 'Tis dearness alone that gives everything its value. Right now, stocks are pretty dear.
Well, I look at the market, and there's really three drivers of returns that we're seeing for investors, right? It's the earnings. Are they going up? In this market environment, they're not. The PE multiples, right? We were trading at a high PE multiple. We're at about 15.2 right now. If we think the S&P is going to generate $123 in earnings, we get 1870 roughly on the S&P 500. So that's above where we're at today. But then the next source of returns are dividends, right? So are you thinking people should start going into quality dividend names, or are you guys shying away from that because you're worried about dividends?
No, I don't think we're worried about dividends. If you look at the corporations and look at their payout ratios, I think there's no question that you can find those corporations whose dividends are safe. I don't think you need to go chase dividends, though. I think really you're much better off if you find a company that you like, write a covered put on it.
Okay, so
that's the best way to go.
Be selective and write the puts.
Randy, it's good to see you.
Thank you.
Thanks so much.
Take care.
Appreciate you joining us today, Randy Bateman.